Hey guys, I'm going to show you the results of the trading strategy that I've been developing over the past month. I put in a lot of research and a lot of money testing different versions of this, and I finally came out to one that back tested well and tested well in a live trading session. So what I did actually was this week was the first week I actually put money down on this strategy and began trading it. And lo and behold, every trade was correct this week. Now, if you were to look at my trades and then to look at what I was trading, and I ended up going with the 3 times leveraged ETF of the NUGT, NUGT. The NUGT, by the way, is a 3 times leverage of the gold miner ETF. We can take a look here. This is the gold miner ETF, and this is the NUGT. They look exactly the same except for the y-axis. On the NUGT, we're trading in the $150 range. In the GDX, we're trading at around $30. The movements are a lot smaller in terms of dollar value. Now, I wanted to trade the NUGT, and one of my experiments was seeing if I could trade GDX instead, because GDX has a much better liquidity in the options market. You can see high levels of open interest here. You can see high levels of total volume here. But if you look at NUGT, we don't have that. We got a lot of zero, or the biggest open interest here is 100. The biggest volume is 360. It's all of these leveraged ETFs don't really trade well with options. But the problem was when I did experiments trading GDX versus NUGT, what I did was I bought them at the same time to see which one would be more profitable. It ended up as the NUGT being more profitable. And it sounds surprising because the bid-ask range and the liquidity present a problem. Look how the bid and ask differ, about $200. But for the GDX, that difference is almost negligible. The problem was, because of the dollar value moving in just small ticks, like a penny or 2 pennies, what you get is options that don't really change in price that much. So even if it does change by like a penny and you bought many contracts, it doesn't really work out as well as trading the NUGT. So it's better to go with the NUGT, sacrifice liquidity, sacrifice the spread for a more profitable trading strategy. Now, I know you're probably interested in the profitability of this first before I get into the details, so I'll go to that. The whole reason I'm making this video is I want to test interest in this strategy, because if it is something that people would be willing to trade, I can make a course for it. I don't want to make it too public because I don't want it to be a phenomenon that gets kind of evened out by arbitrage. But the idea here is simply, if you are willing to make 2 trades a day, one at market open and one at market close, then you can use this strategy. So I'm not sure how many people that works out to be, especially considering that the market closes during within the 9 to 5 work time. So if you have a full-time day job, this probably won't be a good trading strategy. I'm really interested in how many of my followers would be willing to trade this way. So I'll show you how it worked out. I started trading on Tuesday, and luckily every trade paid off. So every one of my trades was correct, and if you didn't know better and you looked at my positions and then you looked at the NUGT candlesticks, you'd think I'd be able to, you think I was like predicting the future here. So here's the profitability first. I spent $1,800, came out with $2,800. By the way, this is all including commissions. I spent $2,300, came out with $2,700. I got $200 from a credit spread. This is a different stock, so ignore that. That was an earnings play. Spent $1,000, came out with $2,200. This is just insurance for that credit spread. Don't worry about that. And then this is the newest play. So every play here worked out. I made a total of 4 trades since Tuesday. 1 was a day trade. The other 3 were just swing trades. Now, that profitability, I guess, is 1,000, 200, 500, so that's 1,700, and then, so I'd say that's about $3,000. The $3,000 and the total investment needed was the biggest value plus the margin for that credit spread. So that's about $3,000 profit on an investment of $3,500 rolled over, and that's within the course of 4 days there. Technically 3 days, because here's how it works. What I was doing was I was buying the nugget I was trading the nugget at market close, and then closing my position at open. So essentially what I'm doing is I'm predicting which way it's going to open on the next day. Is it going to open higher or is it going to open lower? So I would predict that this opens higher, and I'd be right. I predict that this opens lower, I'd be right. Predict this opens higher, I'd be right. Lower, I'd be right. So that's what happened during the course of the week. And as you can see, because of these massive differences in where they open and close, it ended up being a very profitable strategy, especially this last day when I predicted it would open lower. What happened was I bought a put option for $1,000, and on the next day at open, the put option was worth $2,200. So that's more than 100% ROI in one day. So you can see that you do need to be awake, or for me it's awake because I'm in Asia, but you need to be able to trade at the end of the market and close your positions at market open. And if you want to ride a trend during a day, you can do that as well. All you do is you need to make sure that you hedge theta. And if you've taken my courses or are a member of Copy My Trades, you'll see that what I do to hedge theta on a positional trade is simply to, let's say you have calls. Let's say you have this call open. You're long on this call, and the theta is 65. That means you're spending $65 a day just to keep that open, keep that trade open. And that's going to hurt you, because it means that if your direction is right, it has to move, delta is 65 as well, it has to move at least $1 for you to break even. So you've got a little bit of a threshold there. What you can do to overcome that theta decay is sell another one. So you sell a call with a higher strike price, and this strategy is called a debit spread. So you'd sell this one, for instance, and you see that theta is the same as the theta above, so that makes your theta basically zero, and you don't have to worry about time decay throughout the day anymore. So that's how it works out during the day. Now, what I really wanted to talk about here, other than gauging your interest for this strategy, what I wanted to talk about is the idea of a end of the day ramp, because this is what I began researching when I wanted to make this trade. I was looking into what's called the 330 ramp on the SPY. Now, if you read sites like Zero Hedge, you'll see that they explain this 330 ramp as some sort of secretive conspiracy against the stock market going down, and it's central banks and the Federal Reserve pumping money into the stock market. Well, I broke that down, and I went to the very, very basis of why and what was being bought. And I don't think that their thesis is correct at all. Instead, I have a different thesis, and this is what I was looking at the beginning. So, what is the 330 ramp? Well, at the end of the day, what we find many times is that the S&P 500, the Dow Jones Index, the QQQs, they're all being bought at the end of the day, and it tends to ramp upward. So it seems like a no-fail strategy. Just buy the SPY at 230 or 330, and then sell it at market close, and you can make money every day this way. This is what I wanted to try out, but I wanted to try it out on a leveraged ETF. So that got me looking at Nugget, because Nugget is very highly priced in dollar value. Now it is. Before it wasn't. So actually, this is why I want to test your interest in this trading strategy, because before the Nugget wasn't like this. We are basically in the golden age of the Nugget, where it's actually trading at very high dollar values. And I'm worried that one day, if the Nugget goes back to this level, this strategy won't be applicable anymore. So I'm hoping that we can stay in this region for a while, but you never know. It might just be a short-term trading strategy, and we might be able to leverage it for easy and quick profits, but in the end we're going to have to switch to something else. The Nugget is the best 3 times leveraged ETF. I've looked at other ones. FAS doesn't trade at a high amount. UCO doesn't trade at a high amount. These are all 3 times leveraged ETFs that are possibly playable, but didn't work out in my backtest, didn't work out in my live trading. The only one that did was the Nugget. And unfortunately, that ramp that we see in the SPY is confusing with the Nugget. Sometimes the Nugget shows that same 330 ramp. Sometimes the ramp is downward. And the reason for that is, if this ramp is going up in the SPY, then gold is probably going down, because they are inversely correlated at the moment. Now, GDX in that way is kind of inversely correlated with the SPY, but these days sometimes the SPY and gold move in the same direction. So it's too random to say which way the Nugget's going to go. Now that said, you can do it on the SPY, but it's kind of hard to do without a lot of leverage. So I avoided that. Now my thesis here is simply, the reason that this happens is because you have a lot of leveraged ETFs that make deals with other companies to gain the let's go back to the idea of a leveraged ETF before I actually get into that. So what a leveraged ETF does is it allows you to hold 3 times the amount of a certain ETF. So let's say you want to play QQQ, but you want more leverage. You want to be like a perma bull on the QQQ. What you can do is you can buy the TQQQ, which is a 3 times leveraged QQQ. Now, what happens is you're going to buy the TQQQ, which is owned by a company that promises one thing. They promise that at the end of the day, and that time period is very important, at the end of the day, the TQQQ is going to mimic the QQQ times 3. So if the QQQ moves up, we'll find how much it moved up, moves up 90%, then the TQQQ needs to move up 2.7%, and we're basically there. So that's how it works out for you, the buyer. But how does it work out for the company, TQQQ? Well, the company TQQQ makes a deal with another company. What TQQQ does is they give a bunch of money to another company, and that other company says, I promise to give you 3 times whatever the QQQ makes at the end of the day, each day, every day. And what that company does is they hedge. They hedge by buying more QQQs at the end of the day. And because they're buying a lot of QQQs at the end of the day, you see a ramp at the end of the day in QQQ. So that's where that ramp comes from. It comes from hedgers. People who see that the SPY has moved up, and now to hedge properly, they have to buy a lot of the SPY. Now, if the SPY doesn't really move, you don't see that ramp because nobody needs to hedge. There's no hedging needed, therefore there's no buying going on, and therefore the ramp does not occur. So my original trading strategy was wait to see if you can find when the buying occurs, what kind of movement we need for that buying to occur. And if we see that percentage movement, then we play the ramp. So that somewhat worked out because I found that you need something around like 0.7% or more for that ramp to end up manifesting in the market. So what I would do is I'd watch the stock, and if it moves up 0.7, I'd go to the leveraged ETF and I'd buy the ramp at the end of the day. But like I said, with Nugget, it doesn't really work because at the end of the day, what's happening with the Nugget is it's being modified by both the overall market and the price of gold. And because the Nugget is inverse with the SPY, the ramp tends to be downward, but we can't rely on that. So I ditched that idea, and I noticed that there are a lot of gaps in the Nugget, and that the difference in the day-to-day close to open prices was large enough to where if we can figure out a pattern in the Nugget, what we could do is we could just play at the end of the day and then close at the open of the next day. And essentially we're in the market no time at all. Like, our position is not open except for overnight. And in the end, what should happen is we get big profits because of these jumps. If you look at the daily, you'll see the jumps more accurately. So here's the daily chart, and you see these jumps, quite large from day to day. So that's what I wanted to leverage. That's what I built the strategy off. And after my first week of trading, it showed that it actually did pay off to the tune of 100% ROI. So if you're putting $1,000 down, you can expect to get $2,000 the next day. That's how it worked out so far. Only 1 week of trading, so not a huge sample size, but the back tests worked out well, which is why I decided to go and use actual money trading this. So again, my questions to you would be, are you interested in this? Would you have time to trade this? And what would you prefer? Would you prefer a course on how to trade it, how to predict which way it's going? Or would you rather prefer to have some sort of like live chat where I say, okay, here's what's going to happen today, buy, sell, and so on? Again, I don't want to make the actual strategy too public. If too many people play this, I'm worried that the trend will disappear. So I hope to make this either a back-end product or a back-end signal service. Let me know your thoughts. I will appreciate it.